Hey guys, welcome back to Investing in Stocks for the Long Term. This is Tom. So, this is a relaxing Sunday I'm making this video on, so I figured it's a good time to talk about the lazy man's active stock picking that has destroyed the market year after year. It is nets. These stocks are amazing, okay? Uh, Warren Buffett actually made most of his money investing. His best returns were investing in these nets. Now, hold on. What is a net? All right. Now, a net. Benjamin Graham came up with these. Now, Benjamin Graham, of course, was Warren Buffett's mentor, and he actually had about 20% annual returns from 1936 to 1956. So he was beating the market consistently with this strategy. Now, he may have not been using the net strategy the entire time, but he switched over to it as basically his only strategy. So what is a net? Well, for Graham, it's a stock that is priced at no more than 2/3 of its net current asset value. Now, how do you calculate net current asset value? It's simple. Don't glaze over. It's just your current assets subtracted by your total liabilities, whether it's pensions, leases, etc. Okay. There's some other ways to calculate them where you're even subtracting some of the current assets. You're looking at how much cash it has per share, but the research shows that just the regular assets minus liabilities, net current asset value, you want to pay less than that. So you've got what's called a cigar butt. You're picking something up off the ground that works. Now, in my last video I talked about moats, and I talked a lot about the negatives perception on these value traps and these cheap value stocks. Okay, you've got to do a lot of research if you're looking for at value certain types of value stocks, because you got to find a new one. In this case, though, you basically just let a screener do the work for you, and there's several out there. I'm not sure what the best one is, but basically just let the screener do the work. You invest in a basket of all these stocks. You can screen out the ones you don't want, like the possible Chinese frauds, and that may actually be one of the reasons that this strategy has not performed as well the last couple of years. But let me tell you first what Buffett said. Okay. He said, the many dozens of free puffs I obtained in the 1950s made that decade by far the best of my life for both relative and absolute performance. Now, from 1957 to 1969, he was getting 29.5% a year. He was killing it. Okay. Since then, he's gotten about 20%, if I'm not mistaken. So, about 10% extra when he was able to do the nets. Now, we'll talk about why. You probably already know, but we'll talk about why he's no longer using the strategy, and the moat thing has taken off so much. Now, quickly, there's another investor, Joel Greenblatt, famous book, You Can Be a Stock Market Genius, which I will do a review of, great book. He did a study that spanned part of the mid 70s. I think it was about a 6-year study, and he showed that the nets were dramatically better. I don't have the numbers off the top of my head, but I do have links to another study. Oppenheimer did a study from 1970 to 1982. The stocks that traded under net current asset value had returns of 28% versus 19% for the small caps. Tobias Carlyle did one from 1983 to 2008, beat the market by 22%. Then there was another study that looked at the Japanese nets from 1989 to 2007, and they about more than quadrupled the returns of the Japanese market, which were somewhat depressed. But now Greenblatt, he had a 10-year stretch. Now hold on to your seatbelts here. A 10-year stretch of 48.5% starting in the 1980s. Now, that seems like a misprint. How did he do it? He had uh, some other little tweaks he may have been doing besides net. He was looking at liquidation things. He was looking at just bankruptcy, special situations, and all that. But he came up later with this magic formula investing, which looks at a high return on equity stocks and stuff, and it's done okay. But originally, he was using this modified, and now we're getting back to that paper that he did in the 70s. He looked at 4 different versions of net stocks, and he found that the ones that performed the best were the ones, they all performed well. They all performed well. But the ones that performed best were under 85%, priced at no more than 85% of net current asset value, with a price to earnings of under 5. That took you to 42% returns for the year. So you can see these are some amazing returns you get from these nets. Now, why are more people, including me, not investing in it? One, it's under the radar. People are ignorant, and we just don't really realize the type of returns that these things give. Number 2, it's too boring. Okay? You don't really get to choose. Yeah, you can screen certain things out and you can decide to concentrate in certain areas, but a lot of times it's boring businesses, failing businesses, or semi-failing businesses. You don't get to invest in the Apples. You don't get to invest in the Facebooks. You get to invest in some little rinky-dink thing that you hopefully will get bought out for double the price. Okay. The idea of what Warren Buffett is doing now, the current strategy, number 3, is like, okay, everybody's looking at moats. Everybody's looking at how can I find moats. Okay, and so that goes down and that influences people. The thing though is, the reason, that brings me to the next point, the reason that Buffett no longer does it, and the issue that could be a problem for some people, is size and liquidity. Most of these things are under $100 million market cap. Okay, they don't trade very much. So obviously, if you're a big hedge fund, you're going to move the market. It's not going to be enough to move the needle. But for you and me, I'm assuming that's probably not an issue for you. Number 5, people think it's too much work. Okay, but like I already said, you don't have to turn over a bunch of rocks. You let the screener do the work for you. You can screen out whatever criteria. If pharmaceutical companies that burn a lot of cash, or things that have a dividend, for some reason the dividend stocks, the dividend nets actually underperform. So you can do a little work. You can make it more interesting, but you don't have to do that much work. You can outperform the market just buying the basket, finding the screener, buying the basket, sitting back and relaxing. So let's see. Are there any more reasons? Now, you can't, number 6, you can't get big returns. You can't get 10 baggers. Now I'll give you an example from my own portfolio. I had Gravity, the South Korean game stock, down about $4 in 2016, $5. Quickly it popped up to $17. Then ultimately it went to 90. Now that was a business turnaround. Their online Magic Earth Ragnarok took off and did well. So sometimes you can get some spectacular returns. Sometimes it turns into be a great business. Now, I'm not going to say that that's common, but it certainly can happen. So now another one would be, number 7 would be periods of underperformance. Now, lately we've been in a period of underperformance. I don't have the exact stats, but as you know, unless you've been living under a rock, value stocks have not been doing well lately. This does apply to nets to a degree. Now, they've still been doing well, but they have not been doing as well as the NASDAQ the last 5 or 6 years from what I've read, and about 15% a year versus 17% a year. But sometimes they'll even go negative for a year. This is not a trader IBD sell stop type of deal. This is where you invest, you rebalance, depending on what the stocks have done at the end of the year. Now, with no commissions, of course, it's much easier to implement this without getting hit by commissions. So your returns are certainly not affected by that. Now, number 8 would be, it currently isn't working that well. We need to buy Facebook. We need to buy, pick it on Facebook. We need to buy Apple. We need to buy Shopify. Yeah, there we go. Shopify, Zoom, Peloton, whatever. But, that to me is a little bit of a sucker's game. If you want to be a trader and you want to make that work, there's a lot of rich people right now who are making that work. But I'm looking at the long term. I'm looking at what's been working over the past year. So I'm going to try to start putting a chunk of my portfolio into net nets. I haven't decided exactly how I'm going to screen them out. But if you guys have any ideas about what the best way to screen them and what the best way to do this would be, just let me know down below in the comments. The lazy man's easy way to beat the market, net stocks. Let's see. Now, if you are looking for a site that screens them well, I would say Serenity Stocks is a good one. Looks like they've got a good one on there. So until next time, peace out.